Gazi, Fugazi, it's a Wazi, it's a Woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real, right?
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks mostly fell on Tuesday as weakness in big tech weighed on the broader indices, and it was a fairly light day of news, and as a result, we actually saw quite a bit of market rotation. AI stocks took it on the chin. Nvidia down 3.5%, AVGO roughly down the same, AMD was down 5.45%. That is despite some very positive news we got from Intel with regards to SoftBank and the US government, etc. And we could see stuff like Arista Networks, Dell, they took it on the chin, Microsoft, Oracle, Palantir down 1%, 5%, and 9% respectively. Palo Alto after its earnings up 3.06%. And you could see AI stocks, especially in the big tech names, really took it on the chin, Google and Meta as well. Then you see Apple only down 0.14%, falling in sympathy with regards to the other mega cap names. However, because it's not a pure play, direct AI play like Nvidia or AVGO, it was down 0.14%, and that really did help, the mega caps in aggregate. But we saw very positive price action everywhere else. When you look at the consumer discretionary, apart from Amazon and Tesla, the rest of this was really, really positive, including Home Depot on the back of its earnings. Consumer defensives were green. Industrials were very green. Real estate, utilities, healthcare, financials, every single sector was green except for the tech sectors. XLC and XLK were down 0.56 and 1.75% respectively, and that's why the SPY was down 0.54%. But the equal weighted S&P 500 was actually very positive today, and every other sector gained, everything from discretionary energy all the way to real estate, staples, utilities. A very, very positive day through and through. A little bit concerning that we do have some of the defensive sectors like real estate, staples, utilities, and healthcare at the top end of the heap, but every other sector did gain, and it was a very positive day through and through. This gives a better overview of the market. You can see that growth really did take it on the chin, both in small caps, mid caps, and large caps. Particularly large cap growth took it on the chin. But value and core across the board were green, from large caps, small caps, mid caps. A very, very positive day of just incredible market breadth. And we saw roughly the same across the globe. European stocks, were very, very green. Same with Asian stocks, except for Southeast Asia. And again, that's because a lot of this region makes AI stock stuff like Taiwan, Indonesia. They're big AI players, and that's why these stocks were kind of red. And then South America, Brazil, also really just took it on the chin for whatever reason, I don't know. And then obviously North America, because of what we saw with the mega caps, was down today. But when you look at the broadening, we did actually see quite a bit of broadening, particularly in Europe and Asia. And ultimately, that's where you get a lot of your value names. And that was a rotation we saw today. Now, like I said previously, it was a slow news day. There wasn't much going on. The market was really just trading on the technicals, waiting for the Jackson Hole speech from Jerome Powell this Friday. But we did get some very, very encouraging housing data. Housing starts beat expectations by a lot. 1.42 million housing starts versus the consensus of 1.29. That grew 5.2% on a month-over-month basis. That's positive, beating expectations. Building permits came in at 1.354. That actually missed expectations ever so slightly. So essentially what housing starts is telling us that construction that's currently happening is going to be strong. It's going to remain robust. However, the pipeline for construction could be a little bit weaker than expected. You could see building permits fell 2.8% on a month-over-month basis, and previously that actually fell 0.1% as well. So starts good, building permits was sanguine, and this does suggest that construction will remain robust, at least until current builds are complete. But this right here does create a little bit of concern about the pipeline. We also got an interview from Scott Bessent, and he actually said some, I would say, fairly bullish stuff in aggregate. He said that tariff revenue will be revised up substantially from the $300 billion mark this year. He said that they will use tariff revenue to pay down US debt and bring down deficit to GDP. And that actually did help the yields market as well as the dollar. We'll talk about that when we get on the charts. He came out and said, we're pushing back on countries around the world on the digital services taxes. That's actually really positive for some of the mega caps. So despite that, you think mega caps would be up on that news, but they weren't. And he came out and said about some things about Intel. The last thing they want to do is tell Intel how to do business, because the US government will be getting an equity stake in Intel. And then he also said that Nvidia will require a license for any new chip to China. Then that was on the back of Nvidia coming out and saying they are developing a new chip for China based on its latest Blackwell architecture, just because the H20 or the Hopper chip is about 4 years old. So the new Blackwell architecture is going to have increased performance and they can charge more for that chip looking ahead. But Nvidia will need a permit for this, and it's obviously going to come with a lot of hurdles that they'll have to get over, but eventually they'll get that chip into China. Now, looking at some other market movers here, Home Depot was up nearly 3% today, despite a relatively tepid quarterly showing, which saw comparable sales rise 1%. However, the company told investors that it would stick to its guns on its annual guidance, reaffirmed annual guidance, and Home Depot came out and said it would raise prices because of tariffs, something it said it wouldn't do last quarter. Both have been taken as bullish, making it the best performing component of the Dow Jones today. Very, very interesting. And we're going to cover this name on the second YouTube channel. So go ahead and follow me on the second YouTube channel so you don't miss a beat, guys. Now, Intel was up 5.89%, and it has been gyrating in recent days on reports that the US government will convert its CHIPS Act grant into equity, giving it a 10% stake in the chip maker. It seems to be moving in that direction, with SoftBank announcing it'll also invest $2 billion in the company. And that is why Intel is up in a very big way. Now, Palo Alto, the cybersecurity firm, was up 3% today as well after reporting very, very strong earnings. Revenues rose 16% on a year-over-year basis, but the real standout was RPO, which rose 24%. The company issued better than expected guidance as well, with RPO seen pointing to a future increase in revenue. And then Palantir, one of the AI losers today, was down 10%. This could actually potentially be the top for Palantir yet. I expect the stock to continue to move lower, especially considering its elevated valuation. And then for everything we saw today, there was 2,700 advances, 3,600 declines. We saw net inflows, surprisingly, in the New York Stock Exchange, outflows in the Nasdaq 100, the S&P 500 down 0.59%. And the market momentum continues to remain really, really solid. And as long as this is the case, this is simply an opportunity to buy the dip. Yes, we have lost a 5-day and it did deteriorate from yesterday, but everything else is still looking relatively positive, relatively strong. And this is a market you don't want to short. You just want to buy dips and go from there. Guys, and diving into the charts, we could see the mega caps, the large caps really took it on the chin. The Nasdaq 100 in particular down 1.39%, when the RSP, the equal weighted S&P 500, was up half a percentage point. Now, again, that goes to the broadening, and especially with rate cut expectations, that's going to benefit the broad market. And that is why we're seeing this broad market rotation. However, I want to see the Russell 2000 perform. It was down 0.78%. But when you look at profitable small caps, profitable mid caps, they were in the green as well. Stock outperformance, with value completely outperforming growth. And again, this is something we noted last week. We said there was a rotation occurring under the hood, and we needed to see that have legs. And it does look like that as staying power. So do expect much more of the same. Do expect some churn here from the mega caps, a rotation into the equal weight, a rotation into maybe even the Russell 2000, but more specifically the S&P 400 and the S&P 600, and just a rotation into value, especially in this August and September period. Now, I'm not saying go out and sell your mega caps. They'll still do very well. I'm just saying that we definitely are seeing the early innings of, that broad market rotation, and that normally sees outperformance from the broad market, excluding the top 10 stocks in the S&P 500. We saw roughly the same globally. Now, let's exclude Middle Eastern stocks. Europe was up. India was up, and this is the KWEB ETF. It's the China Tech ETF, right? I mean, if you look at the China ETF in aggregate, it was actually positive today. So this is just down. The tech ETF is just down because, tech stocks weight on the market as a whole, and it was high beta weight on the market. I mean, tech stocks is high beta. The Russell 2000 is high beta. Crypto is high beta, and you can see crypto was down. Bitcoin down 2.72%. Ethereum down 4.2%. And that's just the games you play with crypto. It's super high beta, super high risk. It's why you only keep a 5 to 10% allocation, so it doesn't move your portfolio in crazy swings. Now, looking at the macro, after Scott Bessent's comments, we saw the dollar rise, the 10-year yields, the 30-year yield, and the 2-year yield fall. Volatility did pick up, and the market continued to price in, rate cuts into this market, and we're looking for 25 basis points in September. And that's what the 2-year yield is telling us. In fact, the 2-year yield is telling us we're looking for about 75 basis points through the end of the year, but that's all up to Jerome Powell and what he says on Friday. The dollar sniffing that out, up 0.15%. TLT gained on the back of yields falling. And I mean, if we do get those 75 basis points with the rate cuts, TLT should outperform by a pretty wide margin. Gold was flat, silver was flat, commodities were just kind of flat here today. Now let's talk about the S&P 500. Now, I posted my game plan for the S&P 500 over the weekend and what my expectation is here in this September and October time period. And it looks like we're starting to see that here in early August. Now, I'm expecting a 5 to 10% pullback that should bottom around the 5,800 area or no lower than that inside this time period right here, somewhere in late September to early October. That means we are going to see that pullback from now into late September up to the 5,800 area. When I posted this, the S&P 500 was 64.49. And in the context of having a strong weekly uptrend, making a weekly all-time high last week, the daily chart for the S&P 500 is signaling that we are looking like there is going to be some form of consolidation, of some form of, the downtrend occurring. You can see right here that we did see a little bit of churn at the top end of the range at here. And then today we had this massive wick down, and we are approaching some of the levels, some of the open levels we saw at the end of last week. If we go to the Nasdaq 100, it looks a bit more volatile. You can see this is a very ugly candle after we've had this stair step lower from these highs. And to be honest, I do think we're going to go lower. Now, some of the levels I'll be looking at, number one is this 22,955 area, call it the 23,000 area, and then obviously the 22,255 area. Now, this area is absolutely key because we used it as resistance right here before the tariff tantrum sell-off. You can see that we use it as resistance right here and right here. And the truth of the matter is that resistance eventually becomes support. You can see multiple times we use this as resistance. So I do expect this to be a strong resistance zone if we do get there. So if we slice through the gamma flip zone, we go right to the 22,255 area, right? That is going to offer us plenty of support. And if we take a measured move from where we are, you're looking at about 4% downside from there. And that roughly aligns with my 4 to 5% pullback. And if you go ahead and actually measure it from a peak to trough basis, right? From the actual peak, you're looking at about a 7.18% pullback. So still a little bit of downside, but don't expect the mega caps to just roll over. These stocks are the leaders and they are the strongest stocks for a reason. And that's because they're just the best. They have the best balance sheet, the best business models, internationally diversified revenues, and strength in them can come at any moment. So the best thing that you can do in situations like these is have cash ready, and every 5% pullback in the index in your favorite stock, go ahead, buy those dips, and then eventually you're going to dollar cost average, and that way you capture the downside alpha by buying the dip, and you also capture the upside momentum if that turns, because we don't know when stocks are going to turn. All we can do is look at probabilities and assess it and say this is likely where it's going to happen, but it can happen at any moment. And so dollar cost averaging every 5% pullback, that's actually a very prudent strategy just to ensure that you are taking advantage and being a market participant in aggregate. Now, looking at European stocks, I think European stocks are looking like they want to break out. It does look like we are breaking out, and I think that's on the back of this Ukraine-Russia peace deal. I think the market is assessing the fact that we probably will get some form of a peace deal. I think Russia is going to get all the land at once. I think Ukraine is going to get some of the land at once, and then I think that's sort of going to be the peace agreement. Unfortunately, whether you love it or hate it, I think that is what's going to happen. Europe is sniffing that out, and I think we're probably going to go hit all-time highs. I think if we continue to see this broad market rotation into stuff like the RSP, into mid caps, into small caps, I think Europe should benefit from that, because all the European indices is pretty much just like mid caps and small caps, apart from a couple of big names. Most of the stocks in the European sector are under $30 billion in market cap. So if you are looking for out of US equities, I think European equities are really good at the moment. Now, looking at Bitcoin, guys, you can see that we have pulled back to this very key resistance zone right here at this 112,000 area. So I expect this area to hold a strong support. We could have price discovery a little bit below here, but I think this is probably the lows. We'll consolidate here and then make our way onward and upward to the 140,000 area. I think if you miss this Bitcoin rally, this is where you go ahead and buy. We made a new all-time high right there. That's not bearish. I do think we go higher for Bitcoin. I do think we go higher for Ethereum. Now, Ethereum, we said we are looking for a pullback to this yellow line right here. So there is a little bit of downside. So I'm expecting a little bit more downside in Ethereum. It's about 3%. So if you're falling out 3%, don't be surprised. But I do think that we're going to use this zone as support. We previously used it as resistance right here, broke above. We're going to use it as support and continue to move to all-time highs. I do see 6,000 Ethereum before the end of the year. And if we actually take a measured move as to what 6,000 would look like from, let's say, this yellow line right here, all the way to the 6,000 level, looking at still about 50% upside. Seems crazy. That's just how crypto is. And I do think Ethereum is the best way to play that. But don't sleep on Bitcoin. I do own more Bitcoin than Ethereum, but I own both in my portfolio. Now, looking at the 10-year yield, the 10-year yield was down 0.5%. We continue this downtrend right here, and I do think we're going to see much of the same. We can see a little bit upward momentum, but I do think we're going to see a downtrend, or just a downtrend in general, in the 10-year yield, especially if we get rate cuts, and especially if Jerome Powell acts the way he should at Jackson Hole. The dollar seeing a bit of strength. We do know this is the case because of the TGA. I do think we're going to see 100, 102 DXY before the end of the year. Bull case for me is 104 in the DXY. And then looking at gold really, really quickly, we continue to do one thing, and that's consolidate inside this area right here. Ultimately, if you're a gold bull, you want to be buying this 3200 area. And I do think that is probably the right move. I can see 4,000 gold somewhere in 2026. That wouldn't be the realm possibility. Now, yesterday I said I'm looking at a stock that I sort of want to buy into the portfolio for a short-term trade. I think we're going to see $20, and that stock is Lyft. Now, it didn't act too well today, down 2.81%, but I do think that this is still a very, very good buy. I do think any pullbacks we get, even if it's to the $14 or $13 range, buy those dips because the stock is cheap, and I think it's going to outperform, especially as it realizes its European revenues. Now, another stock that I do like is EVVTY. This is a European stock if you want to diversify out of the US. I do think we're going to 100 for EVVTY in my personal opinion. And another stock that I think is worth a buy right now is CoreWeave. On every single measure that I look at, I think the stock was cheap. I think the stock is a great buy here at this $90 area, right? I think if you can maybe sell $85 cash secure puts, you'll collect $5 or $6 from that. We can go from there, but do be aware that this can go to the $65 area. But ultimately, let's say we do slice through all of these levels, I do expect the $65 area to act as strong support because this is where we broke out. This is where we actually put in the IPO high, and then we go from there. So I think $65 is the absolute low, but I see value here at the $85 area, especially considering this company's backlog and how well positioned it is to take advantage of the AI trade. Guys, and diving into sentiment, we continue to remain in the greed territory. However, you want to look at the path as what's happening. Yesterday, we were at the 65 level. We've actually moved into the 60 zone. And I do think we are going to continue to move potentially into this neutral zone, into this fear zone, because I do believe we are going to get a garden variety 5 to 10% pullback in the S&P 500. So guys, if we continue to see sentiment abate, if we continue to see churn underneath the hood, especially in the mega caps, that is completely normal, but it is just a dip buying opportunity because when we look at earnings, right, earnings continue to be extremely strong. This quarter, we're looking at about 11% earnings growth in aggregate for the S&P 500. Then we will get 2 quarters right here of about 7% in Q3, Q4. And this could be another reason why we continue to see churn over the next couple of months. But as we ramp up into 2026 Q1, Q2, Q3, Q4, you can see earnings go back to that double-digit percentage level, 10, 11% right here, 14%, and then 12%. When we get here, that's when we could actually see the markets continue to ripping. And this is ultimately the reason why you actually want to go ahead and buy the dip. Furthermore, this chart right here shows notable shifts in the S&P 500 companies' financial year earnings per share guidance trends with a significant increase in upward revisions here in Q2. So for all in all, if we do get weakness in the market, right, it's a dip buying opportunity because we are seeing positive revision trends and earnings expectations are expected to get into that double-digit territory, especially into the end of next year. So we want to be buyers of weakness. And the S&P 500 is not that overvalued. According to Morningstar right here, as of the 15th of August, I don't have the latest data, we are sitting at about 1.4% overvalued in the S&P 500. So if this is to continue to move lower, let's say by another 5 to 10%, and we are to get to sort of like this level right here in valuation, that would simply be a dip buying opportunity. But I'm not too sure we're actually going to get here. This was the tariff situation and things were a little bit frothy right here. But if we are to pull back into this undervalued territory, that would just be an opportunity to buy the dip and go from there. Because when we look at the macro, things are actually pretty solid. When we look at the economic surprise index, right, things are actually pretty good. When we look at the US economic surprise as well as the euro area and emerging markets, we're all above the zero line. In other words, economic data is coming in better than the analysts expect. And yes, we have seen a little bit of a deterioration in recent months, but that's just a moderation from exceptionally good data, and things are still well under control, not just in the US, across the globe. And ultimately, we are expecting rate cuts. Now, you can see that the market is expecting a Fed funds terminal rate in 2026 of 3.1%. The TSL, which is TS Lombard forecast, is for about 3.5%. And that's neither here nor there. I think the truth is somewhere in the middle. Regardless, that is telling us that we're looking for about 100 to potentially 125 basis points worth of rate cuts through 2026. And that's going to support small caps, the broadening, and equities just at large. But ultimately, all of this rate cuts is going to come back to the data. And the data we have tomorrow is the FOMC minutes. Now, this is going to be key, especially because we have Jerome Powell's Jackson Hole speech here on Friday. I don't think there's many market pundits saying Jerome Powell's just going to protect his legacy. A lot of people saying he's going to come out dovish. A lot of people saying he's going to come out hawkish. Who knows? Ultimately, a lot of the market movement, particularly in the dollar and yield, is going to come down to what Jerome Powell says at Jackson Hole on Friday. But before that, we get the FOMC minutes, and then we also get existing home sales. And then with regards to data, now with regards to earnings, tomorrow we get Target and Lowe's. These are the two big names, and we're probably going to be covering Target. And go to the second YouTube channel to go ahead and check out the Home Depot analysis. That should be up there in a couple of hours after this. And then on Thursday we have Walmart. We're going to be covering them. So a lot of consumer names here with Home Depot, Target, Lowe's, Walmart. We really get a key insight into the consumer, especially into various parts of the market, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.